You know how when a huge news story breaks, you see the market just go wild? Well, have you ever wondered how it's even possible for smart investors to look at the exact same news and make completely opposite bets? Today, we're going to solve that puzzle. We'll look at one of the most intense moments in recent market history to figure out what really separates a winning bet from a losing one.
Okay, so picture this. It is the very first hour of trading after a war has been officially declared. The tension is just off the charts, and millions upon millions of dollars are about to fly around based on gut feelings, complicated math, and, let's be honest, a whole lot of fear.
And right there, in that first hour, two totally different plays unfolded. On one side, you had a flood of cash going into the obvious war stocks. We're talking energy and defense. But on the other side, people were rushing to bet that the entire tech market was about to tank, running for the safety of government bonds. Same news, completely opposite bets. So what on earth was each side seeing?
All right, let's start with that first group. These are the investors who made the most intuitive trades, right? The ones who were basically following the headlines.
The reaction from everyday retail investors was immediate, and pretty much what you'd expect. They saw the word war and immediately started buying energy and defense stocks. But here's the thing. According to data from VandaTrack, this wasn't just blind panic. One analyst actually called it selective repositioning, a move that seemed totally logical based on the news right in front of them.
And you know what? On day one, it absolutely paid off. The big energy ETF, XLE, shot up to a 52-week high. Palantir, which had actually seen people selling it off the day before, suddenly jumped over 6%. For a moment there, following the headlines looked like the winning move.
So, it felt logical, it was making money, it seemed like the right call. But the thing is, the market doesn't just stop after day one. And this, right here, is where the story gets way more complicated.
And this is where history gives us a pretty stark warning. If you look back at the 2003 Iraq War, Fisher Investments found something fascinating. After that initial spike, the defense sector actually did worse than the rest of the market for the next 6 months. That quick win? Yeah, it didn't last.
And look, this wasn't a fluke, it's a pattern. Research has shown that the top US defense stocks almost always surge the moment a conflict is announced, but then those gains tend to vanish within a few months. Why? Well, think about it. The second war is declared, the market immediately prices in years of potential government contracts all at once. After that initial sugar rush, the stocks just have to sit and wait for the actual money to show up, and that can take a very, very long time. So now let's flip the coin and look at the other side of the trade. Let's talk about the investors who basically ignored the headlines and focused instead on the deeper structure of the market itself.
And this, right here, is the key difference. This group wasn't really trading the war. Nope. They were using the war as a trigger, a shock to the system that they believed would expose a major vulnerability they already saw in the broader market. So what was their evidence? What made them so sure? Well, they were looking at things like the Shiller P/E ratio. It's just a fancy way of measuring how expensive the stock market is over the long term. And it was showing that the S&P 500 was trading at levels as high as they were right before the dot-com bubble burst. So they saw a market that was priced for absolute perfection, just as a huge, imperfect shock was about to hit. So while the S&P 500 was kind of just sitting there, not doing much, you could see it in two completely different ways. Viewpoint one was, hey, the market is strong, the fundamentals are solid, we can take this hit. But viewpoint two, the contrarian view, was, whoa, this market is historically expensive and it hasn't even started to deal with this shock yet. The real move hasn't even happened. So, which side did history favor? Well, if you look at past conflicts, it's pretty clear that markets have been incredibly resilient. In the year after the Gulf War started, the S&P 500 was up about 20%. After the Iraq War, up over 26%. In fact, historically, markets post positive returns within a year of a war starting about 73% of the time. And that right there is the core lesson. The real opportunity, historically speaking, wasn't in chasing those day one winners like defense stocks. It was in buying the quality companies that got beaten down by all the initial fear and then recovered beautifully over the next year.
Now, this doesn't mean you just go out and buy anything that's falling. Of course not. There's a huge difference between a company that's just temporarily down and one that's actually broken for good. So here's a simple framework, 3 questions you can ask to tell the difference.
Okay, first, why did it fall? Was the war the only reason, or was this business already in trouble? Second, and this one is absolutely crucial, does it have enough cash in the bank to survive a 6-month downturn?
because a company with a ton of debt can go under before the recovery ever shows up. And third, is its customer demand just delayed or is it gone forever? Think about it. Travel demand usually bounces back after a crisis, but demand for one specific airline route might be gone for good.
This framework also helps us see the timeline of how these markets tend to work. The first week or two, that's the news trade, that quick pop in defense and energy. Then, for the next 1 to 3 months, it's often about the inflation hedge, as things like gold react to all the uncertainty. But that 3 to 12-month window, that's the sweet spot. That's the recovery trade. That's when the quality companies that passed our 3 questions really start to shine.
And here's the trap that so many people fall into. They pour all their energy and money into stage 1. They buy the headline, they get frustrated when the trade stalls out, and they usually sell before the real long-term opportunity in stage 3 even gets started.
And that brings us right back to where we started, doesn't it? Back to that first hour of trading after the war began. You had 2 groups looking at the exact same news. One group reacted to the headline, the other, they analyzed the structure of the entire market that was hiding just behind it.
So the next time you see some massive breaking news headline flashing across your screen, I want you to ask yourself, am I just seeing the news or am I seeing the structure? Because what you choose to see is going to make all the difference.